Hi, everyone. My name is Steve Seeger, and I am the Director of Acquisitions and Investor Relations here at SNS, joined today by CEO and co-founder Jared Sturm. Jared, thank you for taking the time to join me.
Yeah, Steve, I think you got another great video coming, so appreciate being a part of it.
Yeah, so thanks to everyone who's taken the time to watch this. I'm just going to give you a brief overview of what we're trying to accomplish today. We're going to go over, as you can see on my sheet here, an example underwriting analysis that we go through at SNS as we're looking at deals. This is a hypothetical deal, so the data inputted here is not pulled from anything actually that we're looking at. This is also just a typical value add plan that we're going to underwrite for here. So at SNS, we are operating on a 10-year hold usually, where in the first, usually about 2 to 3 years, we're stabilizing the property, aiming for a year 3 refinance, and producing cash flow. So I'm going to focus this conversation really towards the returns each time that I'm making adjustments. And the main goal of this is to just stress test a financial analysis and show you what are three big things that can really flip the returns on an underwriting. And my goal is to just illustrate that a general partner who leans more aggressively on their underwriting can make their returns look great. But at SNS, we would rather underwrite conservatively and underpromise but overperform. So, Jared, before I jump in, is there anything you want to add?
Yeah, I think you hit a lot of it, Steve. But I think to give the investors or those who are watching this video some peace of mind is, I think it's a very difficult task to ask of an investor to know these stress tests and these subtle nuances and all the tweaks that we can make in that any GP can make in their underwriting. And so I think what your video may accomplish is just illustrating how important it is to pick the right general partner that you trust that they won't do those things and they will underwrite conservatively, because at the end of the day, it's impractical to expect LPs to understand all the nuances that could be tweaked in an underwriting. And even if they did, it's hard to say exactly where those should shake out for a specific market or a specific asset.
Yeah, yeah, and I'm going to try to keep it simple. There's three things that I'm really going to stress test here and show you. The first one being the market rents, and the second being the cap rate. And finally, I'm just going to adjust to expenses in our projections tab, but I'll dig into that later. Um, to start here, we're looking at the first page in our analysis, which is our property info tab. And typically here, I'm collecting as much information as possible about the units. I'm looking for the bed, bath, unit count, and usually we'll analyze the rent roll to figure out what the current average rent is. And this cell right here, the SNS market rent, is where I'm going to start working with today. So in this first scenario, I've just plugged in a 14.8% loss to lease here. So from 1,000 to 1,175 is where we think we can take this by budgeting for renovations. We're usually around 12,000, I think, is a good estimate. Jared, would you say that's fair for our reno budgets?
Yeah, this is just, again, hypothetical example, but just a very basic 100-unit community with half one bedrooms, half two bedrooms. And the business model is invest about $12,000 into renovations and push the rents up by 14.8%. So that's the way we're underwriting it in our base case, right, Steve?
Yep, yep. And I would like to highlight, before I move these market rents, the current key metrics, which this is what I look for in deals. And usually these two metrics highlighted green are the two that are going to have to pass there's a rule of thumb that I try to hit before I decide to move forward and keep digging in on our analysis. But the first one being the internal rate of return for our investors. So that's the IRR. And this percentage is a average over the 10-year hold. And I'm typically aiming for about 12% here. And the second number that I'm looking at is the average annual return, excluding the sales proceeds that we receive at the end of the hold period for our investors. And this is, in other terms, this is the cash on cash return. So the percentage that you're getting each year in cash flow. And it's also the average over the 10-year hold. And I've highlighted or I've copied and pasted what the numbers are currently with our current base model. And this is right at our goals that we like to hit. And this is probably where we would underwrite the deal. But we're going to show you how just changing one of these can fluctuate these numbers greatly. And I'm just going to keep adding as I go. Jared, before I jump in, is there anything that I maybe missed here on the return metrics page?
I guess to clarify, one thing you said is the bright green is typically what we present in the OM. You and I are looking at all the other metrics to make sure they check out, but we highlight those because that's where our investors' eyes typically go, because that's how they're presented. And then you've locked in that base case in this blue chart to the right. So as we adjust variables and stress test the analysis, we'll be able to contrast what it was originally, kind of how S&S underwrites, to how easily it can be manipulated through a couple tweaks in our underwriting. So I'd love to see it happen.
Yep. All right. Well, let's jump in first with adjusting the market rents. So right now we're only at $1,175 for these one beds. I'm going to move it up just by $25. So I'll change it to $1,200. And let's see how much that just the one bed's being moved, adjusted from these original returns to where they're at now. And then let's look at what adjusting the two beds even up a little bit too would look like. So I'm going to move it up to from 1290 to 1320. So these aren't large changes, one might think, but they do impact the returns greatly.
Mm-hmm.
Jared, do you want to comment here on how much of a difference this actually is versus maybe what it might look like?
Yeah, I mean, in the average annual return, excluding the sale, we're almost at 200 basis point swing, right? That's a significant difference when considering the investments. And back to my original point of, you changed it, I believe, $20 on one bedrooms and $30 on another bedroom, and that was roughly 2 to 3% move in rents, right? In the pro forma rents. And I just think it's very unlikely that an LP is going to know the market well enough to say, after you renovate, is that valid that you can achieve, this rent or $20 more than this rent? And the GP should know how to pin that down exactly. But to your point, Steve, and why you're making this video is to illustrate how easy it is to manipulate these return numbers and how difficult it would be for an LP to validate the variables that feed into the returns. And so I think it's a really good illustration of how conservative underwriting relies on the GP and trusting the GP to make sure they're not just adding $20 or $30 to the rents just to inflate their returns by 200 basis points.
Mm-hmm. Mm-hmm. Yeah. And I'm going to jump over to cap rates here because this is going to be one that also swings at a large amount too. So right now we're underwriting for a 6.5% refinance cap rate. And I'm only going to move these 25 basis points, each of these, the refinance cap rate and the sale cap rate. And again, one more time, this is where we started. We're at right now with just the rents moving. Let's drop this down from 6.5 to 6.25. And we'll also move the sale cap rate by the same amount. So dropping it from 7 to 6.75%. And let's jump over to our key metrics and see how much that swings it. So again, these returns look great. I mean, just from changing the cap rate by 25 basis points, this makes this deal look from good to completely amazing. Jared, do you want to comment a little bit on cap rates and how we like to approach this in our underwriting?
Mm-hmm. Yeah, I mean, cap rates are challenging for anyone to guess because it's a function of the sentiment of the market and the desirability of that asset. And so it's a little bit subjective, and you do your best to understand where our specific market is. I mean, S&S has a competitive advantage to only be focused in Cincinnati, only focused on one asset class, and only focused on a niche within it, which is like C to B class. So we have a pretty good understanding of this vintage, this desirability will generate this cap rate. But being off by 25 basis points in a cap rate is pretty easy to do, even if you understand the market really well. So again, it'd be extremely hard for a LP who lives in a different state to understand, 3 years from now, once this property is renovated and we're analyzing the cap rate 3 years from now, which is a bit of a guess anyway, Is it 6.25 or 6.5? Like, you're not going to be able to validate that. So you have to be able to trust your sponsor who's underwriting the deal to lean more conservatively and make a guess that they can live up to, or most likely live up to.
Hmm. And at the end of the day, one of the things that I think we benefit from is being so focused on that one area. And you highlighted it. We benefit a lot from that. And it is a guess at the end of the day, too, on the cap rate because it's farther out, but an educated one. So
Yeah.
again,
You know that if we were buying a deal in a market that we had never invested in or participated in, we might have to lean on other industry professionals like real estate brokers or mortgage brokers to say, what is the cap rate? But
mhm,
not always a direct alignment of interest of what they're going to tell you, right? So like the real estate broker is potentially representing the seller, trying to make the property look as good as possible and make you believe in the upside as much as possible. Where because we're so focused in just Cincinnati, not only do we know our assets and what they're valuing at and trading at, Steve, you're tracking this for every deal that we look at, right? What is the NOI? What is the sale price? What is the cap rate? And how do they all kind of intertwine to produce what we believe is a justifiable cap rate on the next deal? One kind of thing I'll bring up, Steve, you may want to just zoom in a little bit on these just to help viewers if they're looking at it. It looks like you're already at 125, so maybe we're okay.
mhm.
But yeah, cap rate is one that can very easily be tweaked and abused in underwriting, and so you have to be very disciplined in your approach. And Steve, I know you are, and SNS as an organization is, to put our most conservative foot forward on what that number is for both the refi and the sale.
Mhm. Yeah, thanks for adding that. I'm going to jump over to expenses here and just continue to add on. So this is the third and final category that we're going to um, edit here. And this tab here is our projections tab. So in this part of our analysis, we're looking from year 1 to 10. What's going to be our income and our expenses? And we can look at the investment more holistically here. This does take a little bit of time to go through and make sure we're accurate on, but there's two things that I want to edit here. And the first one being property insurance, and the second being our payroll. I think these are two large ticket items for expenses that you can get more aggressive on for your analysis. So right now, I just have a base case plugged in at 500 a unit, and I'm going to adjust it down to, we'll say, 400 a unit and see what that does to returns. So made that change, and that's just $100 change per unit for property insurance. And again, the returns continue to look better and better just from these minimal changes. I'm also going to update the payroll expense. We'll go down from $86,000 a year to 70. So down $16,000 a year in what you're paying your maintenance team. And you're looking at a pretty incredible deal on paper. But when you look back at the base case where we're underwriting more conservatively, it's still a good deal, but we're more realistic with our numbers. And I think it lends back to the under promise, over deliver that I mentioned at the beginning. Jared, with these expenses, is there anything that you'd like to highlight that I may not have hit?
Yeah, I feel like in each of your three stress tests, I keep saying the same thing, but bringing it back to the idea, posing it as a question to the LP, like, how would you know as an LP that a 1980s vintage multifamily 100-unit multifamily in Cincinnati, Ohio should be an annual premium on property insurance of 40,000 or 50,000? Like that's our job to know that, and it's sometimes even challenging for us to know exactly what that would be in a volatile interest rate, or not interest rate, volatile insurance climate. So we do our best to guess that, but it's just unrealistic for an LP to know what that number should be. Similar to posing it as a question, what does it cost to pay a maintenance technician and maintenance supervisor salary and benefits in Cincinnati, Ohio? It's not realistic for an LP to know exactly what that number would be down to a couple percentage point swings. So realistically, you have to rely on the GP to know that number, and it's so easily manipulated to produce a metric to then throw into the OM to make the deal look better than they may be able to live up to. And at the end of the day, we try to lean more conservatively. And I think that will then, well, I know it does then show up in our track record in that comment of under promise and overperform. And our track record shows that. And so I think that's why investors have grown to trust the numbers that we present in the OM, is because we're not taking advantage of these easily manipulated accounts. And there's much more than what you just showed, Steve, right? Like we could go into really nuanced ones, and you can make changes to all of them pretty much, and slowly tick up these returns. But the question is, as a GP, can you actually live up to it? And do you believe that you can actually achieve that? And I know what it costs to pay maintenance technicians and supervisors. And it's like, I'm not going to get the quality we want if we cut that down a little bit. And we're not going to get the insurance coverage we want if we cut that down a little bit. And so I think it's just important to pick a GP who you trust to not abuse those things.
Yeah. And like you said, this is just 3 basic items in our model. There are so many more that you can edit to make these returns look better on paper, but we're realistic here, and it really can change an investment that you're looking at greatly by just a couple small things. So that was the goal of this video, is just to be as transparent as possible and show you what we're doing in the back end when we're underwriting. I do want to thank you guys for taking the time to watch this, and hopefully these videos that we're producing are continuing to be valuable to you, good learning tools for deals that you're looking at. Jared, do you want to add anything before we wrap up here?
No, I think you did a great job, Steve. Hopefully it's an opportunity to even just a peek behind the curtain on how you underwrite deals. Obviously, we didn't go into too much depth just looking at these stress tests, but we do a good job of making sure we're considering all those variables when we are underwriting.
All right. Well, thanks for joining me today, and I'm looking forward to getting this video out to everyone.